Hi guys, this is Katie Andy with InterLinc Mortgage, and today I want to talk to you about the components that make up your out-of-pocket when you are purchasing a home. So most buyers know that you're going to have a down payment requirement. So down payment is going to be the difference between your purchase price and the loan amount that you're borrowing from the bank. The additional components of out-of-pocket are going to be your closing costs as well as your prepaid items. So let's touch on down payment first. So on a conventional loan, you can do possibly as little as 3% down with really strong credit, up to 20% down or more to avoid MI if you want to look at those. On an FHA loan, the minimum down payment is going to be 3.5%. That's the same for every buyer. If you are a veteran and you are eligible for veteran benefits, you would have a zero down payment. It's 100% financing. And then if you're buying in a rural area that meets geographic requirements, you could go USDA, which is a rural housing loan, and that is a zero down payment. Now, even if you have a zero down payment program such as VA or USDA, you're still going to have closing costs with your lender and third-party fees, as well as your prepaid items for taxes and insurance. So let's go into that next phase. So that's your down payment options, right? So your closing costs are going to be made up of lender fees, which typically are going to be a 1% origination fee. Most lenders charge an origination fee, although it can be a point of negotiation. Some buyers elect to pay that in their rate over the life of the loan as opposed to paying it in a cost out of pocket. Or in addition, you could even look at buying the rate down and using discount points, which is just paying interest up front basically for a lower monthly payment. So those are going to be negotiable with your lender. Most lenders also have some sort of administrative cost to cover the cost of their support staff. So for instance, we have underwriting, which covers the cost of our underwriters. We have a processing fee, which covers the cost of our processing team. We have a lender admin fee, which covers the cost of our juniors. So our transaction coordinators, our junior underwriters, the people that are involved in the process to help make it as streamlined as possible. So those are our lender fees. Now, in addition to that, you're going to have attorney fees that are associated with preparation of the note and the deed of trust and preparing the documents. You're going to have third-party fees also associated with an appraisal. Appraisal prices are going to vary per lender based off of what they have negotiated with their appraisal management companies. But on average, you can expect to spend between $485 and $650, give or take, depending on whether you're buying conventional or if you're buying FHA, if it's an investment property. Those things play a part in what sort of pricing you're going to have for that appraisal cost. You're also going to have credit cost for the cost of your credit report. You're also going to have a flood cert to verify your property is not in a flood zone, or if it is, what flood zone it's in. And then you're going to have a tax service fee, which that has to do with tax reporting that we do on the back side of it. Once we've closed and funded the loan, we have to report certain things. And so those are what you're typically going to see on the lender side. You also are going to have third-party fees for your title company, for your surveyor, for home warranty, those particular items. So regardless of which lender you go with, those fees are going to be whatever they're going to be. But we will average those and give you a quote whenever we prepare a loan estimate. That way you can see itemization of what to expect. From there, so those pretty much make up your closing costs. So you have your lender fees, you have your third-party fees, you have your title fees. Title fees are going to include the cost of closing at their establishment, which is called a settlement fee or an escrow fee. And it can range anywhere from $250 up to $750. It really just depends on the title company. And then you have title insurance, which that is a state-regulated item. It is going to be based off of your loan amount. And so that's, again, it's going to be the same regardless of which title company you use. The survey, if it's needed, is typically going to be between $300 and $500. And that, of course, the survey is what shows you the blue line outline of your property, where your property begins and ends, so that you know where your property lines are. It also shows you any easements. If you're going to, put in a pool, you need to know if there's utility easements that run across your back property line, so things like that. So those are your third-party items. If there's a homeowners association, you are going to have probably some homeowners association dues that are prorated based off of, the month you're closing and whether they collect annually or semi-annually, or if they collect monthly. So that's something that can be a variable. And then they typically have like a one-time transfer fee. If it's new construction and a new build community, they might have a capitalization fee that's a one-time buy-in. So those are just things to be aware of. So jumping from closing costs now into prepaids. So your prepaids are your recurring costs that are going to happen the whole time that you're in the home, right? You're going to have to pay interest every month on your mortgage. You're going to be paying homeowners insurance annually. You're going to be paying taxes annually. So at closing, we collect for your interest. We collect from the day of closing through the end of the month. So for instance, if you close May 15th, we're going to be collecting per diem interest from May 15th until June 1st. And then your first payment's not due till July 1st because your July payment will pay your June interest and your August payment will pay your July interest because it's always paid a month in arrears because we can't charge interest until you've used it. So that's how that works. So if you close earlier in the month, you'll have more days of per diem interest. If you close later in the month, you'll have fewer days. So that's how that works. You also are going to be required to have your first year's homeowners insurance policy in place, and that's collected and paid for at closing as well. So you're going to do 1 year at closing for your first year's homeowners insurance. We are then going to move over to your escrow account, okay? Your escrow account is required to have a certain cushion in it at all times. So when we set up your escrow account, we're going to put a certain number of reserves in there so that you don't end up with a negative balance or a shortage in your escrow account at the end of the year. Whenever we set up your insurance, we're going to put 2 to 3 months of insurance in your escrow account. And then same thing on your taxes. So if your payment is due, if you close May 15th, first payment is going to be due July 1, right? So in July, you're going to start putting money into your escrow account from your monthly payment, okay? So we want to make sure from July until May of next year, when your insurance renews, that you have 12 months worth of payments built back up to then pay the next year's policy. And we'll do that each year. So you're paying 1/12 of your annual premium in with your monthly payment into your escrow account. And we are setting up initially with 2 months so that when your first payment hits, you'll still have 12 months when it renews in the following year. Okay? And then on the real estate taxes, same thing. Taxes are due by the end of the year. The bills come out in October. Payments are due by December 31st. So we're going to set up your escrow account with the month that you're in. It's basically you take the month you're in and plus 3. So if we close in May, we're actually setting up 8 months of payments into your escrow account for taxes. However, the seller is responsible from January 1 till May 15th, right? So you're going to get a credit into your escrow account from the seller for their portion of taxes. And then what's out of your pocket as the buyer is the 2 to 3 months cushion that's required to go in there. And again, so you've got 12 months built up by the time it's payable in December. So those are your components that, again, you've got your down payment, your closing costs, and your prepaids. If you have any questions, please let me know. I am always here, happy to help. My number is 817-807-5367, or you're welcome to ask your agent as well. Have a great day, and I will see you next time.